Brian, always good to see you. So, I mean, you heard what Bob Pisani just said. Europe potentially rocked by this. I mean, wouldn't that be important to everybody's earnings, including industrials?
Great question, John. Thank you so much for having us. It's an honor. If you're familiar with our work, you'll know that we've been excessively critical of Europe for about a decade. If you go back and look at what's happened to Europe the last 20 years, depending upon what GDP estimates you're looking at, the Eurozone has lost 10 to 12 full percentage points with respect to its GDP and its percentage of world GDP. We've said for a long time that it's a diminishing asset and a value trap. And the things that were spoken about by Bob just previously in terms of earnings going down, that makes a value trap very, very likely in Europe. And I think that's why we've seen the U.S. markets, believe it or not, be a world of kind of relative resiliency, number one, in terms of equities, and from a safe haven status with respect to what's happened with treasuries and the dollar. And so we still think that North America is the place to be with respect to on a short-term basis as we continue to be very reactive on a short-term basis with respect to the conflict in Europe.
So what about the Fed then, Brian? Because before people were worried about what's happening in Russia and Ukraine, or worried about the Fed and the rate hikes and how that's going to slow growth and affect markets. Is infrastructure spending more certain than the Fed's impact is uncertain?
It's a great question. You know, when the Fed came out last week and talked about and basically telegraphed 25 basis points, they provided some certainty, and there was so much uncertainty with respect to whether or not it was going to be 6 or 7 interest rate increases. You know, we really think that the Fed has done a great job. Fed funds futures doesn't necessarily have a great predictive value to it historically, and I think too many people were focusing on that, John, quite frankly. You know, we still think at BMO, according to our great economics team, we're going to see 125 basis points of increases over the next 12 months. From an investment strategy standpoint, we think we're going to see 25, 25, 25, and then kind of wait to see what second half earnings look like, which, oh, by the way, continue to look quite well. In terms of your infrastructure bill perspective, I think industrials are teed up to lead for the next 3 to 5 years, especially given what we've seen or what we're going to hear from infrastructure. But increased CapEx, if indeed putting aside, all the political stuff in terms of drilling for oil. If we're going to see increased CapEx, that's very good for industrials. And then lastly, this theme of increased defense spending. If we are indeed heading into another Cold War period, remember what President Reagan said, peace through strength, peace through strength. You've already started to see some countries in Europe start talking about increased defense spending, and that's very good for the U.S. defense makers.
3 to 5 years. I thought you were going to say 3 to 5 months, Brian, which many investors would take even for a stretch of outperformance, but that would really be something. Why do you tell people to resist the temptation to go overweight consumer staples right now?
Evans, nice to hear you. Listen, staples are expensive, Kelly. They're expensive. There are areas in staples that'll benefit from this inflation side of things. You know, Costco is technically a staples company. I think Costco is a top 25 company in the world. Yeah. So you definitely should be owning Costco and Walmart, Kelly. But if you take a look at these packaged products, the soup makers, cereal, we're not eating that stuff anymore. And at the end of the day, they're not defensive assets anymore. I think the playbook is buy consumer staples when you're worried. But I think the most consistent earner in the entire S&P 500 is big cap tech. John knows it well. So I think if you take a look at what's really earning and the consistency of earnings, it's Microsoft and Apple over Kellogg's and General Mills.